The US CPI data for August was released yesterday, but looking at the market reactions, you would be forgiven for thinking that nothing has happened. So let's take a deeper look into the data to see what it's telling us about the US economy, and then jump on the charts to look at some of the key indices. Hello and welcome back to our channel. My name is Daniela Hathorn, and in today's video, we are going to be reviewing the US CPI data released yesterday on Wednesday, and we'll be jumping onto the charts to look at some of those key equity indices, specifically the S&P 500, to see how it's performing, gearing up into the Federal Reserve meeting next Wednesday. But before we get into it, please like this video, comment if you have any questions or suggestions, subscribe to our channel, and don't forget to turn on your notifications. So as I was saying, the US CPI data for August was released yesterday, and you could be forgiven for thinking that nothing has happened looking at the data and looking at the market reaction, because we have seen a lackluster performance from equity markets, but also FX markets, bond market as well. We haven't seen that much of a move in US yields. So essentially, pretty flat reaction to that, essentially market shrugging off the data. So let's dig into a little bit deeper to see exactly what the data is telling us. So just off the bat, the actual data, US headline CPI year on year grew 3.7% to the year to August. Expectations were for it to grow to 3.6%, so higher than expected there. The month-on-month reading for headline came in with line at 0.6% monthly growth. Core CPI for the year-on-year figure, 4.3 was expected, and that's what we saw. And then the month-on-month reading actually coming in a little bit higher for core as well, 0.3 versus 0.2. So there's a little bit of a mixed reading there, a bit for everyone. You can look at the parts individually and analyze, and you can look at it in unison, all of them together. But essentially, the key takeaway is that we do still have high and persistent inflation. As I said, let's dig a little bit deeper into what the data is telling us, because if we look at the trends within price pressures, they've actually just confirmed that they are continuing what we've seen in the past. Essentially, services continue to make up the bulk of inflation. We know the services are driven mostly by wages. So we're seeing a strong labor market, and that is keeping the services sector strong, and that is translating into the majority of that CPI data coming from services. Goods inflation is pretty much non-existent at this point. As we know, we were coming out of the pandemic and we had all of those supply chain issues. We saw goods inflation really picking up, pretty much non-existent in this latest reading. Food inflation is falling, and energy disinflation is actually reducing. So we've seen throughout the past few months, a lot of the reduction in the CPI data has been because of that drop in energy prices. We've now got oil and fuel costs picking up once again. So that is allowing the headline CPI to grow, not so much from a rebalancing effect because it's affecting that way, but the reduction in the disinflation process is allowing CPI to come in higher than expected. So those are essentially the key takeaways from this reading. Looking at core inflation has actually been the key sticking point, and it's actually the one that should be most important for the Federal Reserve. If we're looking at fluctuations in fuel, they shouldn't actually affect their view on monetary policy. So a lot of the reaction in the market actually coming from the back that markets are not expecting the Federal Reserve to change course at their meeting next week. There is a 97% chance priced in that we won't see a rate hike next Wednesday. It went up from before the data. Before the data, it was 93%. So pretty much a done deal at this point that we're not going to see a rate hike from the Federal Reserve. And if you were looking at the headline from the data yesterday, you saw inflation picking up more than expected. 2 months ago, inflation fell to 3%. It fell more than expected, and it fell to the upper bound of the Fed's inflation target. As we know, 2% is the target. They've got a range either side of it. 3% is the upper bound. When we saw inflation drop to 3% in June, we actually saw a lot of rebalancing in expectations in markets of when the terminal rate's going to happen in interest rates from the Federal Reserve. and how long are those terminal rates going to be held in place before seeing a cut. Of course, now that we've seen inflation pick up to 3.7% in 2 months, we've actually still got markets believing that we're not going to get a rate hike at this meeting. And the odds for a rate hike in November are currently at 40%. So still pretty unsure as to whether we're going to get another one later on in the year. So a lot of this likely focusing, as I said, on that core inflation. Core inflation is actually at the lowest it's been since October 2021. So core inflation, which is excluding volatile prices like energy and food, has continued that downward trend, and that is keeping hopes in the market that we will not see further tightening from the Federal Reserve, at least not at their meeting next week. So essentially, even though the reading felt like it came in hotter than expected and was going to really push bond yields up and was likely going to cause the Fed to reassess their decision, looking at the data, because we know they are extremely data dependent. If you dive in a little bit deeper and look at those trends within the inflationary reading, we actually see a positive trend in those areas that we want to see it. And a lot of this rise has come from that resurgence in energy prices. So all in all, it's been a pretty positive reading, and we've seen that, as I said, slightly in the markets, a little bit of a lackluster reaction, but we have seen equity markets picking up some momentum there, as markets are still pretty much dead on that we won't see a rate hike from the Fed. Another thing to look out for is the PPI data, which will be out today. Of course, PPI is inflation starting at the beginning of the production line before it gets to consumers. So obviously a data point to watch out. But again, I doubt that we'll change views about the meeting next week, given what we've seen in the data and given that markets are still expecting potentially another rate hike further down the year, but not just right now at the meeting next week. Let's jump onto the chart now to see how equity markets have been performing. Okay, so here we have the S&P 500 daily chart, Capital.com via TradingView. As you can see here, I've marked on the chart some of those most important events that we've seen over the last few months, pretty much since the start of the year. Of course, we've got those Federal Reserve meetings, but also the CPI releases, which have been so important to drive momentum recently. Here we've got the drop to 3% that we saw in June that came out in mid-July. And as you can see, we saw some positive momentum in the US stock market on the back of that. We also need to consider that when this data came out, we were already in a period where we'd seen growth overextended. We were a little bit of overbought conditions. You can see here the RSI was pushing above the 70 line already. We've seen some sideways consolidation, attempted reversals along the way. So even within that period of overextension, we still saw that positive reaction from the drop in CPI, actually managing to hold as we neared that July FOMC meeting, where we saw another 25 basis point hike, especially them saying that they weren't expecting this to be the terminal rate because a soft landing was being achieving, and therefore further rates could happen down the line. They didn't say when, but it was likely. So again, a little bit of a risk-off potential there from the messaging from this meeting. We still saw stocks holding on to that momentum there. Turning to the downside as we started the month of August, then we saw the US CPI rise to 3.2% in July. This data coming out here at the beginning of August. We saw a little bit of a pullback on the day, as you can see, and then that ensued with a little bit of negative reaction. We saw a risk-off sentiment across the broader market as well. That really taking hold there for the stock market. Since then, we've attempted to recover some of those gains, found some resistance along the way, and pretty much been stuck in a sideways consolidation now for the last week or 10 days. As you can see, the data that came out yesterday, CPI rising to 3.7%, not really providing much of a direction. In fact, that candlestick there providing pretty much an indecision pattern. We've got that wick and tail either side of the body of the candlestick, that shortened body, suggesting that even though there was a drive to move higher and lower throughout the session, we just managed to end the session pretty much flat in the middle of the candlestick. So lacking some momentum here in the short term. Looking at the RSI, we're getting the same picture. You can see here hovering around the 50 line, that midline. Again, not really much of a drive here. We know the RSI, one of those sentiment indicators, not really showing bullish or bearish sentiment at the moment. It's just a case of let's see what happens next. And I think, of course, the next catalyst is going to be the Federal Reserve meeting on Wednesday next week. I think a lot of the reaction is going to be in the messaging. Do we see Powell, even if we do see a rate hold, which I think at this point is pretty much a done deal, do we see Powell really staying adamant on his hawkish messaging, suggesting potentially a rate hike in November, alluding to the most recent data saying that yes, even though some of the components within core inflation continue to show a positive downward trend, energy prices are picking up, we still have food inflation happening, services, wage growth. We've seen the latest employment data still showing wage growth in the US. So they could be focusing on that to justify a potential rate hike further on down the year. If that is the case, we may see a little bit of negative sentiment in stocks. We may see them retracing, likely see some support along the lows that we saw back here in August, just around that 43.40 mark. Also, 100-day simple moving average currently at 43.71. We may also see a little bit of support down there. In the ultimate case, if this negativity does intensify and we do drop below the 4,300 mark, the 200-day simple moving average just around 41.87 could provide a good area of support, which is also where we were hovering back here at the beginning of the year. So it looks like for now, going to continue to trend sideways until we find a proper motive to break the direction either way. At this point, I feel like whatever your beliefs are with regards to the future of monetary policy, I think you can justify them. Whether you believe that the data remains strong, the jobs market remains strong, inflation continues to show underlying pressures, so you can justify a rate hike further down the line, even if not next week. I feel you can also justify thinking this is the terminal rate, no rate hike in September, no rate hike in November. The Fed will just hold probably until the second quarter next year before deciding to cut rates. Again, that's also justifiable. If that were the case, we could see some positivity coming into the stock market once again, pushing higher, but likely to find some resistance up ahead as well. I wouldn't be surprised if just around that 4,600 mark, we tend to see those sellers coming back in and pushing price lower. That is it for today's review on the US CPI data. Thank you so much for watching, and don't forget to subscribe to our channel.